For those of you who are sourcing for ideas to play the AI revolution, this is basically the webinar that you need to check it out. Good morning everyone, this is Royston, and today I'll actually be talking about the new investing power couple, AI together with energy. This is something that I have briefly highlighted to the SMT community folks during the last quarterly meeting, whereby I talked about some of the cheapest way to engage in AI investing in today's context. One of it is basically to look at energy sector or the utility sector per se. Today I will further elaborate on that, and I'll be sharing with you which are some of the key areas that you should be mindful about and which are some of the stocks that you can actually be looking at to partake in this revolution. So without further ado, let me get started. A quick introduction again. Over here you can see from this chart that the tech revolution would essentially require huge volume of electricity. So this is basically AI as well as crypto mining, etc., driving the demand for higher electricity. This is a chart which I've shown you guys previously. So from 2024 all the way to the next decade, we can potentially see the demand for electricity doubling. Now, at the same point of time, we are talking about AI, we are talking about AI models getting smarter, and because of that, there's actually going to be more power that is required. And as you can see from the base model, the most basic model to the more advanced model, you can see that there's actually quite a large jump in terms of power requirements over here. And this is something that we should also be aware of. As AI gets smarter, they actually require a lot more power, and that's where the demand for electricity will continue to grow alongside with the development of AI. So which are some of the opportunities out there? Let's get straight into it. And of course, the first segment that we want to be looking at is some of the regulated as well as independent utilities players. So we are essentially buying into some of these power generators, and which are the companies over here that you should actually be looking to check it out. Duke Energy, Southern Company, Next Era Energy, Vistra, Dominant Energy. And today, if you want to actually be buying a diversified portfolio of utilities player, you can actually check out the XLU or IDU ETF. So that's basically an easier way for you guys to be partaking into buying utilities players. And for those of you who have been tracking the utilities segment, you know that they have actually been underperforming the broader market index for a very long time. And even on a year-to-date basis, they are also underperforming the S&P 500 index. So at this current juncture, the market is still not pricing in the potential power or the potential growth in demand for utilities players. And that could be something which might change in the next few years. So these are some of the companies that you might actually want to actually be checking out. Regulated as well as independent utilities. The difference between regulated and independent is that for regulated, typically there is I would say a cap pricing involved already. So whether this is good or bad, we'll have another discussion at a separate webinar session. But over here, it's basically on a longer term contract basis. So they might not be able to have spare capacity as well as pricing power. Whereas for independent utilities, they are not capped by any form of regulation by the state. They might have additional capacity which will allow them to charge higher for the electricity generation. So do check out the difference between some of them. I will actually be talking about it in, again, a separate webinar session altogether. Now comes the exciting segment, but also the most risky part. Fuel cell manufacturers. So these are usually the smaller cap players, the more nimble players that's able to provide electricity on the go based on a battery system. So a lot of these players, they are typically small cap names, less than 3-4 billion in terms of market cap. Some even only a few hundred million in terms of market cap. So definitely there is a risk over here, or actually a very high risk over here. And most of them are not profitable. And to be really honest, the balance sheet is also not in a good state. But of course, if the demand for their products really starts to skyrocket moving forward, and that could potentially translate into some form of financial turnaround, these stocks are definitely going to be the one that most people would be having a quick punt on. So do keep your eyes on these players. Some of them is seeing some form of initial rebound. Definitely not yet a strong uptrend, but quite a number of them have actually seen a rebound. The counter that I've highlighted to you guys during the quarterly meeting is Bloom Energy. So I believe that this is one of the bigger market cap names across these 4 players. So you can actually check it out, or you can actually just basically have a quick punt on these 4 players. But do note the high riskiness of investing in these companies because they can go under any time. Plug Power used to be one of the most popular fuel cell names out there after COVID period. So you can see the share price actually rallied substantially, and then it also came crashing down substantially. So again, something to be mindful about, that it can go up very fast, it can also come down very, very fast. Be mindful of that risk. Next up is nuclear power, which is more seen as clean energy. And there are a number of players that is in this sector that you can actually check it out. So Next Era Energy, Constellation Energy, Exelon, Entergy, Dominant Energy, Duke Energy. These are basically companies in the renewable as well as having some focus on nuclear power. So do check them out because most of the data centers or the new data centers that is coming on board, essentially they have committed to using renewable energies or clean energies instead of the typical coal-fired electricity generation or natural gas electricity generation, etc. So their commitment is basically to build a greener community, and therefore the commitment over here is to use renewable energy. But of course, renewable energy hasn't been able to keep pace with the increase in demand, and they therefore have got to find other alternative sources. And a lot of time, a lot of these data centers projects are being held back because they are not able to find the electricity source. So these players at this current juncture, some of them might not be seeing the kind of strong demand as of yet, but potentially moving forward as they start scaling up their capacity, that is where you're going to see more potential for usage of their clean energy. Alternatively, if you don't want to be getting into individual nuclear power names or renewable names, you can actually check out the NLR or URA ETF. So these are basically ETF that is linked to nuclear power companies. So nuclear power, another sector, which is also kind of like linked to renewables. Natural gas companies. Now, I have mentioned just now that a lot of data center have actually committed to using renewable energies, and natural gas is not exactly a renewable energy. It is still dirty in some sense, but not as dirty as coal-fired power plants. So alternatively, this is basically where the data centers will next turn to if they cannot find the renewable energies from companies that is not generating sufficient renewable energies at this current juncture. Some of the big players over here are the likes of your EQT, Southwestern Energy, as well as Chesapeake Energy. So these are the 3 big boys with regards to natural gas production. Do check them out. I think that at this current juncture, the potential for natural gas companies is not being reflected in their share price as of yet because there is influx of supply. There's more supply than demand at this current juncture, but if AI trend really starts to increase the demand for electricity substantially, then this basically will be where they are coming in to fill the gap. to use natural gas to actually be generating electricity, and you can see or likely see demand for their natural gas to skyrocket moving forward. So keep a lookout for some of these players. They are potentially in the initial stage of a rebound. A lot of them have actually underperformed the general energy sector, but potentially this is one area or one cheaper area that you can be looking at moving forward as well. EQT, Southwestern, Chesapeake. Next, power purchase agreement provider. So these are basically companies that are locked in to longer term contracts. So this could be good, this could be bad. Good is that if they are able to lock in at a good rate moving forward, that basically they have already calculated will give them very good internal rate of return, IRR, or return on their investments. That is good. So there's visibility in that sense, but also at the same point of time, if demand continues to increase, spot prices continues to trend higher, then they will not be able to partake on those bases as well. So it is both good and bad, and a lot of the renewable players are basically locked into power purchase agreements on the longer term basis. So some of the players are, I again mentioned, NextEra Energy, First Solar, Brookfield Renewable Partners, as well as Pattern Energy. So again, a lot of these players are in the renewable segment, which typically have such PPA agreements. Something to actually check it out, because like I already mentioned a number of times, data centers have committed to using renewable energy to power their electricity demand moving forward. So more and more of these guys would likely be seeing higher demand for their renewable sources. Next up, or the final segment, would be interconnection firms. So this is basically an area which most people would be neglecting of. So these are the ones that is providing the electricity cables to transmit the demand. And this is something that most people are not looking at. And they have actually been quietly appreciating over the past few years. Actually, demand has actually been very steady. On a year-to-date basis, most of these players are actually up roughly about 20 to 30%. Nexant, Prysmian Group are both, I would say, not listed on the US, whereas Howell Incorporated is listed on the NYSE, so you can actually check that out. Their performance has been rather decent, quietly appreciating. So again, something that you can actually be looking out if you are looking at, I would say, less volatile players and good potential for long-term appreciation. I think Hubble Incorporated is something which fundamentally looks pretty robust. So with that, I will come to the end of today's webinar. I don't want to be dragging it too long. I will follow up with a next webinar whereby I will be highlighting which are some of these names which looks technically attractive using the Traders GPS platform. With that, I will see you guys in the next video.